The accounting equation is assets equal liabilities plus stockholders' equity. The financial statements are based on the accounting equation. Now let's talk about an account. An account is simply a record of each asset, liability, and stockholders' equity element. For example, you know that cash is an asset. All the cash transactions will be stored in an account which we call cash. The account is a basic summary device for accounting. You know that assets are defined as economic resources that provide future benefit, and these are some of the assets that you have seen up till now. So you've seen cash, accounts receivable, notes receivable, prepaid expenses, inventory. All these are asset accounts. Long-term asset accounts include land, buildings, equipment, furniture, fixtures. All those are names of long-term asset accounts. On the other side, you get liabilities, which represent debt. The liabilities that you've seen so far are accounts payable, notes payable, and accrued liabilities. There are additional accounts, but at this point, these are the only accounts that we'll talk about. As you remember, stockholders' equity refers to owners' claim to the assets, and stockholder equity accounts include common stock, retained earnings, dividends, revenues, and expenses. To refresh your memory, this document provides a summary of all the stockholder equity accounts and what those accounts hold. Common stock account contains the owner's investment in the company. Retained earnings account has all the cumulative net income and losses less the dividends paid out. Dividends has whatever was distributed to owners. The revenue accounts increase in equity by providing goods and services. So whenever we sell goods and services, all those transactions go to the revenue account. Expenses relate to the cost of operating a business. So whenever we have a transaction that relates to an expense, it will be recorded in the expense accounts.